Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. Really excited for my next guest. Her name is Madhavi Jain. She's the president and wealth strategist at Think Outside the Stocks. She manages a diversified portfolio across multifamily, self-storage, industrial, senior living, and multiple other strategies. But it's all based on her philosophy, your investments, your choice. She's also co-founded a company called Connected Capital. It's a collaborative community of capital raisers and fund managers where she helps busy professionals build generational wealth through a two-part approach: infinite banking for efficient savings and risk-managed commercial real estate syndications for passive income. Her mission is to change the financial trajectory of one family at a time. Madhavi, thank you so much for being here. I really appreciate it.
Thank you so much. It's a quite a bit introduction there, but I'm sure that as we have a conversation, it's going to be simplified for people to understand what we do. It's all interconnected, all interlinked. But thank you so much for having me on your show.
Oh, you're welcome. You come highly recommended from Bobby, and I've known Bobby for years, and I just so blessed to know him as a friend, and we've done some business together as well. So I appreciate
Absolutely.
you being here. But
Bobby is a great friend, though. So thank you so much. It's an honor.
You're welcome. So your story began when you moved from your home in India, 9,000 miles from the U.S., with your husband, 2 suitcases and a few $100s, which many would think is a pretty risky move.
Mm-hmm.
But why would you do that? What would cause you to take such a huge risk?
I asked that same question to myself even now. But quite honestly, Benson, when I was in my city before marriage and I hadn't even met my husband, I would always tell my mom that I don't want to, marry outside of my city. I don't want to leave city, forget the state or country, right? I never wanted to, change anything because, as it is, getting married in the new household is a big change. So for me, it was like, okay, as much as possible, I'll keep it steady and I'll figure it out. And that's about it, right? But life has a completely different book written for you already. Half of it is written, half of it's what you make of it, right? So in that book, it was destined that, I move outside, not just my city, my state, but my country. So 1 year after the marriage, we moved out to UK first, and then we came back to the country, and me and my husband actually got assigned a project in state. So literally 3-4 days right after the move back from UK to India, we just gathered everything that we had and we just packed up those suitcases, and I followed him to be here with that job. The H1s were really, really hard. It's getting hard over the period of time as well, but I was here at the dependent visa and got converted to a work visa pretty soon too. So it was the job and the opportunities, and I'm so grateful for this land. This has ton of land opportunities, and we are the first-hand example of this. And when I came away from my city, 9,000 miles away from my birthplace, with those 2 suitcases and few hundred converted dollars, I quite often say that we all have uncommonly common story because it's a risky move, but I have seen thousands and thousands of people even to date floating to the country, this land of opportunities, because with a dream and because of the opportunities and what they can make of it. And I think it's proud to look back and see that we actually did make most of it.
Yeah, it's really amazing what you've accomplished so far. And so many people, there's lots of talk about the American dream, right? And, the good and the bad of this country, there's still a lot of people that just think that, the U.S. is such a bad country and there's no opportunity here. And, we should be like other countries. Do you have any sort of opinion on that? Like what is your opinion of the opportunities in the United States?
Like I said, that it's a half of our book is already written, and half of it's up to us, what we make of it, right? And it's not always an opportunity, right? There's a lots and up and downs, no matter where you live. Even if you stay in some of the best opportunities, but the up and downs that you have, if you can't cope up with that, and you just collapse, I think that's the wit that you really need, no matter where you are, to make most of that opportunities. And being in US, I think I always tell my both my kids, both of them are entrepreneurs, by the way, and they started their journey as an entrepreneur pretty early in those days. I said that even if you get a drop in the ocean, right? If you get a drop in the ocean, some people to turn their head to what you're offering, what services you're offering, and what you're genuinely trying to do to make changes in lives. I think that's the biggest thing. Going back to the up and downs, right? I mean, we came to this country, starry eyes, American dream. Like I said, it converting the dependent visa to the independent working visa, that was crucial. I could make that happen pretty quickly. We had a job, and I was working, me and my husband both working with one of the top 5 consulting companies, and we purchased our first home. We had our car, which was, at that time had a GPS on it. Had our first child in this country.
Wait a
and,
second. You
about
just
to
said
give.
your car had a GPS on it?
Yeah, it had a GPS on it. It was a Honda card, and it had like those, square boxes GPS on it, which was pretty fancy
Oh, okay. I thought
for
you
that
said like
time.
people maybe were like tracking you because of your visa.
No. The GPS is no. And
Okay.
this is the map,
Gotcha.
versus those paper folded map. I don't know if you remember those
Yeah, I
days, right?
do.
But what I'm trying to say that, right, that we had a house, the kid born, they have a car, we have a top 5 consulting job. It was an American dream, right? But then 2008 happened, and 2008, when we were about to give birth to my second child, both me and my husband, by the way, we were working on the same project at the point, got called in the office and said that, hey, next Friday is going to be the last day on this project. And what it means in consulting term is that if within 2 weeks, if you don't find anything, that's a job loss. So imagine we are on a work visa, not even a green card, with an elephant of a house in California, one kid here and one kid on its way. And it was, tremendous setback. So, like I said, that it's a land of opportunity everywhere you go. But if you have that up and downs, and if you cannot come back from it, it's a disaster, right? So you got to just kind of, put your willpower together, and with the wit, consider, focusing on that. So that's what we did. We kind of rebuilt ourselves. Most of our money, what it was in stock market. We all know what happened to the stock market. Real estate, we know what happened to that. We had to move from California to Austin. Again, with the job, it was not a choice. It was with the job. We had to move here. And when we moved here and we restarted our life again in 2015 with my health, I had to quit my job, the top 5 consulting job, 6-figure earning income. I had built up my career to it, and it just came to a cliff. So that's when I had to start this whole journey in a reverse order of financial freedom. I didn't had before I left my W-2, I didn't had a path for financial freedom where I have, that cash flow coming in, and then I'm slowly going part-time and leaving my job. It was a cliff. I had to build from scratch. And that's when I started being a landlord, just building a passive income stream, one stream at a time. Soon realized that's not, that's not a passive path, and, jumped into the syndications. And I look back at what life has given me. And there's, we have rebuilt ourselves 3 times in this country. And I look at it, and it just, every time it just feels like, when there is a calamity that you face, you just rise even stronger and harder. And that's how it has felt. And every time we came back stronger, the relationship wise, the financial wise, we just came back stronger and rebuilt and rebuilt. And that's why the importance in being humble about where we are, because we just built it from scratch, so many times. And that's what I would kind of, have a longer answer to your question, that what do you think about this country? But, this is what it is. It's life, what you can make of it.
Right. Yeah, I really think it is. It's what you make of it. If you can get back up after you've been knocked down, right? And there's always an opportunity here, which I think is where I think, because I was born here. My dad's family originally is from Mexico,
Mm-hmm.
and they came here on a work visa. And then my dad was born in Wyoming, and he grew up on a farm, and so things just sort of improved for us over time. But so it's that
Yeah.
first family that really has a hard time kind of getting set up and building a foundation for all their kids and everybody after that,
Right.
which
Right.
makes me feel so grateful that somebody did it before me, and the right
Yeah.
way too, right? Because there's some that don't do it the right way, but there's that's a whole different podcast, really. um
Absolutely. And then you make a good point that, going back, even if you're kind of a second generation in this country, I'm a first generation immigrant. But, we always remember stories from the humble beginnings that we have, and you as a child too, from your parents' lifestyle, right?
mhm.
There's so many humble beginnings, humble memories that we have. And I think that keeping us grounded is really important.
Yeah, it is. So you had some challenges, that were based off, the economy. A lot of people had the same challenges in 2008, and the Great Recession, and then you rebuilt, and then you had some health issues that had put you
Mm-hmm.
another setback. But then you found real estate, which was your first sort of attempt at financial freedom and being an entrepreneur. But you quickly realized that it wasn't passive, right? So you had to be an active sort of person when it came to managing the property and all the stuff that comes
Yep.
with
Yep.
bad tenants. And then you found syndications, right, which is a whole different business. But your approach is unique because you pair it with two really powerful structures. So infinite banking, which
Mm-hmm.
is that the protection, the savings vehicle, and then you combine that with risk managed syndications,
Yep.
which is a unique combination. So let's talk about infinite banking first, because I think that was probably the most misunderstood of the
Yep.
investing strategies out there. Let's explain that for the audience, what that really means.
I love that question, Watson. And to kind of jump back where I started this journey, right? When of course I had that experience about being a landlord and having that one bad tenant, and I started dwelling into the syndicated world and mostly multifamily apartment syndication. I came across infinite banking as well, right? So infinite banking and syndication. Now real estate, I think there is some kind of magic to it. People, when they hear real estate, there's stars in the eyes. It just gets like really excited about it. And when it comes to infinite banking, and when I realized that infinite banking is based with that life insurance product, right? The whole life product. And then there is kind of completely contrary emotion versus what we have for real estate, right? One kind of makes your heart really excited, and one makes your heart very, very skeptical. And I was no exception for that, right? When I heard about it, I'm like, oh my God, nothing good can come out of it. So I was very super skeptical about it. And tell you what, like many, immigrant, like I come from the tech background too, right? I'm very analytical. I'm very, very well versed with numbers. I'm a math major. So I took that back to my spreadsheets. I created a scenario where I could, look at the syndication. I could create a scenario when I could look at infinite banking. I created scenarios when I could look at both together. And it was mind blowing what I figured out. And, I kind of built something to educate myself. And I just realized, my goodness, that this is really, really effective. So to step back and answer your question, what infinite banking is, right? So imagine you're in a strategy, right? Something, and I kind of like that you distinguished that it's a saving strategy. Yes, it's a saving strategy. It's a foundational strategy. And in real estate terms, if I may explain, when you talk about a house, right, you talk about the foundation and then building the house on top of the foundation, going all the way to the roof, right? You don't start building from the roof. You start building from the foundation. And what's the importance of the foundation? If anything happens, right, the roof takes the first hit, then the walls, probably the foundation is going to stay no matter what. I mean, we use terms like the house burned down to the foundation. We do not say that the house burned down with the foundation. We say to the foundation. That means as long as you have foundation, you can rebuild it, right? So infinite banking is that foundational aspect. is that savings, is that emergency, it's your sleep well money, that money that you can decide that, okay, if something happens to me tomorrow, if something happens to me medically, life challenges, my job, there are certain expenses that are there in my, as a protection, as a buffer that I need to do that are there in my bank account that can help me survive 3 to 6 months, right? So I'm talking about that emergency foundational money, the sleep well money. For the lack of better institution, where do you keep it? Pretty much in the bank accounts, right? FDIC insured, again, has a magic to it. We think that our money is safe there, it's not going to deplete. But I am known to ask, challenging questions. So let me ask you a question. When you say that your saving is not depleting, and even current environment, probably it's getting 4% or something, money market interest rate, you're really happy that, hey, 4%, it's really great. So here is a challenge. There's certain blind spots in your saving strategy that you don't even see. The number one, the blind spot is taxes. You don't pay taxes every month that you get paid the interest, but you pay taxes at the end of the year. But these taxes get deducted from your top tier. It's not from the bottom tier, from the top tier, right? So 30 to 40% taxes on that, whatever the 4% that you're earning, that comes down, that brings it down to about 3%, 3.25%, right? Now on top of it, if the inflation is placed, it's about 3% average. There was time a couple of years back, it even crossed the double digit, right? So with the inflation, it's already kind of net negative or even, net zero for say. But the interest rate, the foundation that we started with, that interest rate is 4% today. A couple of years back, do you remember what it was? It was less than 1%. Do you remember that time? Right? So that's the fluctuating interest rate. So it's not 4% ever. It's less than 1%. It's 2%. It's fluctuating. It's everywhere, right? So that's the blind spot that your saving institution has, that you need to come across for your emergency money. Your emergency money should never deplete. It should never be net zero or net negative, right? So now imagine that saving strategy, which can grow your money compounded. It can grow tax-free. So within this vehicle, the taxes does not come out as it's growing, right? And you can leverage from it and use it tax-free while you're alive. You can, use it for any purpose. You can use it for your kids' college education. You can use it for your retirement. You can even use it for your real estate investments. Now you can build this compounded tax-free growth over a period of time, years after years. And it has guarantees built into it, about, depending on what institute it is, about 3% to 3.5% guarantees are built into the contract. That's not changing year after year. But these institutes have been paying dividends, which is on top of that, right? It's that guaranteed growth or the dividends that you get that has been being paid over the period of years. And it's been like some of these are like even 150 plus years. So that consistency is what you want to achieve in your saving strategy. So now your saving strategy is more robust, and as a cash flowing, compounding growth, tax-free growth, you can utilize for any purpose. It has never lost money in 150, 170 years, even through the Great Depression. That's the benefit of it. But the benefit you have to be very, very careful about. Once you have decided that you want to build an infinite banking structure, it has to be very, very precise. Number one, it's very, very important, everything that I'm going to say here. It has to be with mutual companies, not the stock companies, mutual companies. It has to be with the whole life dividend paying, not your index universal, not any variable product, but it has to be dividend paying mutual companies, whole life product. And lastly, and it's very, very important, it's not just any life insurance with mutual company. It has to be strategically structured to have a lower cost of death benefit so that the cash is building and it's growing, compounding, and growing really well based on like you pushing more money into the system. So that's really, really important. So that's kind of, I know it's water from fire hose probably, but that is in a snapshot that the infinite banking with the whole life product, mutual companies, strategically structured where you overfund the cash into the system so that it can, on the other side, grow compounded, tax-free. You can use it tax-free using leverage strategy. It has never lost money, and you can use it for any purpose that you want and creates that foundational asset that I was talking about.
Yeah, it's pretty amazing. I have one of these, and
Amazing.
fortunately for me, I think, and anybody's listening, I've structured it the way that you explained it, and it took some time to figure it out, right? Like, why would you overfund it? And you know, and the death benefit is like, that's one other thing that you mentioned, like just the small thing, that's still a benefit, right? It's just you don't
It
get the
is.
benefit
It
from
is.
it while you're alive. But that's the part of like, if you to be able to overfund it, you minimize that death benefit, but it's still really large compared to other policies.
It is. It
Even
is.
if
And
you
if
are putting it as small as it can get, and you can get say 95% of the cash value out, you still have it's still a small proportion, but still way larger than most. What was the other sort of life insurance that you mentioned? Oh, term life insurance, right?
yep, yep,
Much smaller than this structure right here. And so you said you can do with it whatever you want, right? Which means you have liquidity, which is
yep,
different from if you used a bank account and you put your money in the bank. As soon as you take it out, you lose all the benefit. But
yep,
with
yep,
this, you can take it out and it still grows while you're taking that money and earning interest in another investment, like a syndication or
yep,
another thing. And it doesn't have to be invested. You could use it to buy a car if you need to, or you, like you said, your kid's college tuition. You become your own bank.
yep, yep. And if I may, you touched upon two very, very important points there, right? So I'm gonna go back to it and kind of, elaborate a little bit more on it. The one thing that you mentioned, that there is a death benefit and still a benefit, right? When I have clients approach me and structure an infinite banking policy, and they focus so much on the cash value and what their returns on the cash value is, they forget about that there's an extra benefit that's a death benefit. Now think about your bank, right? If you're keeping 100K, 200K in your bank for 4 or 5 years, just for probably education money for your kids, does the bank come back and say that, hey, account holder, because you're doing so great, you're putting 100K in our bank account. If something happens to you, we're going to give $1 million to your family if something happens to you, right? That's the kind of benefit that I'm talking about, that the death benefit, while you are growing that cash value consistently, the death benefit, which is still a multiple of what the cash value have, probably 100K sitting in here, probably $1 million death benefit, and something happens to you, that risk is taken care by that insurance company, and they're going to pay your beneficiary that amount. So that's one thing I want to touch base on that. And the second benefit is that though we start with that smaller death benefit compared to like other whole life per se, structurally, because we want to create that efficiency of the cash, but in a typical life insurance policy, whether it's term or other whole life product, your death benefit never changes. If you start with $1 million now, 30 years later, 40 years later, if that death occurs and that event occurs, it's going to be $1 million passed to your heirs. But with infinite banking, when you're compounding your cash value, your death benefit is compounding as well. So when you start with $1 million death benefit, and I encourage you to go back and look at your policy. By the way, kudos that you have one. The death benefit is also compounding, and even if it compounds and at the rate of probably inflation adjusted, if it is 1 million right now, and if 20 years later, if it becomes 2 million or 2.5 million, that is adjusting to that inflation itself. So it means a lot to have that death benefit. So that was a very important information, a piece of information you mentioned there. Just I wanted to elaborate on that. And the second thing, that's by far my most favorite part. Imagine your savings account. You have 100K and a syndication comes up, or your kid's college education comes up, or you want to purchase probably 100K worth car. You take the money out, you pay the syndication, or you put it into syndication as an investment, or you put it into education as an expense. That 100K stops earning that growth. So the compounding stops, right? But in case of infinite banking, you can actually use it as a leverage. And it's really important to understand the aspect of this leverage, because this is why you can use this infinite banking, be your own bank, as an and asset. It's not an or asset, as in save or invest. That's how the banks work. It's an and asset. It's save and invest. And the way it works is that while you have the money sitting into your bank, your own bank, it's compounding with that dividend that you're getting, and it's compounding tax free. Now say that 100K worth syndication comes through. Now the insurance company is going to help you with that leverage of say 100K. You put it into the investment. You might have, you will have a simple interest that you owe to the insurance companies, but at that small cost where you're compounding tax free, with that small cost, now you can invest the same dollar amount. So now you're saving, compounding, and you're investing. So that is the beauty of the and asset. And this and asset, because it's your money, no questions asked, you get to choose what you want to do with that money, whether you want to use it for your kids' education, retirement, buy a vacation home. Imagine a 529 plan. You have 200K sitting in there and your kids just get a scholarship and you can't utilize that. You have penalties and stuff to utilize that. But in this case, if you save your kids' education money into the infinite banking, and where the time comes and they don't get to use it, you can use it for whatever purpose you want. You can buy yourself a vacation rental or another investment, put that money into it, whatever you want to do, without disturbing that compounded growth. The key is this compounded growth. It needs to compound all the way till the day you die. And while you are living, you utilize all this money as a living benefit when you're alive. And when you pass, no matter when you die, unlike term life, no matter when you die, even if it's 99 years, you pass that, humongous death benefit to your next generation. So there is I always wonder that when you call a life insurance, why do people think that I will never see money? It is about your life. So you live your life insurance while you're alive, utilizing this banking system, and on your death, no matter when you die, a definite income tax-free death benefits gets passed to your heirs.
Right. One of the other, I think, less noticed benefit from this is when you take a loan from yourself, you underwrite the loan for yourself. Whereas if you went and tried to get another loan and use this as leverage, use it as an asset and borrow from a bank, they're going to look at your credit score. They're going to look at how much assets you have, right? So you've got assets in the bank, which is what they're going to look at, your liquidity. And they're going to look at your income. They're going to look at your W-2s, your 1099s to see how much money you've made before they'll even give you a loan. When you borrow from yourself and you're the underwriter, you decide how much money you can get. Now, you can't decide the terms. The life insurance policy decides the terms, but you can say yes or no. You have that power.
Yep. And, a lot of third-party companies, banks also provide this. So you can, shop around if you want to do that, right? But you bring a very, very good point that, this is no questions asked. Because think about it, for providing loan, what do they need? They need some kind of guarantees that this money is going to come back, right? So their first guarantee is your cash value sitting in there. So most companies allow about like 90 to 95% of that cash value to take as a leverage, right? So that's their first guarantee that something happens, that money is sitting in there. The second option is what something happens to you as a insurance policy holder, then the death benefit is going to cover that, right? So that's the reason that there is no need for providing the assets and the laundry list that when you're shopping for a mortgage that you have to provide your 401k and everything, right? And not only that, because it's inside that boundary of the life insurance, the cash is sitting inside, This is asset protected in most states, so the creditors can't even see that, right? And one of the interesting portion of it is that when you actually are, you're filling a FAFSA form for college education, it doesn't have, as asset, it doesn't account for your cash value sitting in the life insurance because it's not accounted as cash value. But if you want to have a certification about you being accredited investors, it shows up and it says that, hey, you have this as an asset, so you are an accredited investor or not. So it works in very, very powerfully and favorably in your favor because it's an asset, it's there, it's constant. Now think about it. If you have, say, 500K cash value sitting in there, and if you take 200K loan for your kids' education, for example, right? What if you just keep on paying that simple interest and you never have ability to pay up that 200K in your lifetime? What happens is if that, $1 million death benefit becomes a couple of million or whatever that death benefit is going to get passed. Now at that $2 million death benefit and you have 200K loan outstanding, that loan is going to get adjusted after your death from the death benefit, which is much higher than what your cash value is, right? So that $2 million death benefit, 200K loan, say for your college education, 1.8 million is going to get passed to the heir. So you're not ever going to pass that liability or, kind of a burden to your heir. So that's really important. And coming back to the loan and the servicing and the underwriting of that loan, because this is not a traditional loan, you don't have any origination fees or points, or you don't have to buy down anything. So this is essentially because it's the money that's there, it's against that, that's the collateral, and your death benefit is, if that situation happens, that's a collateral. So that becomes very, very easy. And with the insurance company, especially when you work with them, within few days, 3 to 5 business days, this loan is available directly to your bank account. And this is not considered as a loan, by the way, when it comes to if you were purchasing in real estate, and how they have that your down payment needs to come from your resources. It cannot come from any loan. So your down payment can come from this life insurance loan. It's not considered as loan. It's considered as cash. Once it shows up as cash in your bank account, it's just considered as cash. And that's why you can utilize it powerfully again and again as an and asset. If you utilize it, say, for a syndication, and in 5 years, you get your exit and you get your double the money back. And when you have the room, you can just put it there as a parked money till you find the next investments and kind of, repay that loan and keep on utilizing it again and again, over and over again as it compounds and as it grows.
So explain to the audience how that interest gets paid. Are you writing a check every month to the life insurance policy if you took out a $100,000 loan?
Absolutely. So, I always say that, understanding the how compounding works is very, very interesting. When you have the compounding going on inside your life insurance policy or the infinite banking structure, the outside loan, you don't want to compound that. I mean, a lot of students actually with the student loan come into that phase, right? That they don't make any payment and their interest that's due gets piled up as a principal and it compounds. The wrong side of interest compounds. So a simple way to look at it is that when you get that loan, say 100K loan, and you have an interest due, you just pay that interest as a simple interest, whether it's monthly or annually, but pay out that interest every year so that you start with a clean slate. Otherwise, I mean, you have a choice not to pay it, and the insurance company will just add that up inside and it will compound as a principal growing for the loan amount, right? So if you say, if it is 100K, it becomes next year, say 105, right? You don't want that compounding to be happening. So pay a simple interest and get a compounded interest paid. That's what, always a recommendation to people.
Right. So we talked about a lot of the benefits. So objectively, what's the biggest negative of using the infinite banking strategy?
Yeah, I think the first of all, understanding the structure and finding, a right person to kind of get education, understanding it well, because I always say that this is your hard-earned money. You're putting, thousands and thousands of dollars of your hard-earned money. And a lot of my clients bring back their kind of policies, and whether it's index universal or other policies that didn't work for them as they had planned, just because they didn't understand what was happening, right? So education is the key aspect of it, that you need to learn what it can do and what you really want to achieve. Everybody has a different kind of a goals, right? Somebody has the education, somebody has investment, somebody has retirement in their mind. So based on what your goals are, your structure is going to be different, your companies are going to be different. There are a lot of aspects of direct recognition or not direct recognition. I mean, it may sound like terms, but a lot of nitty-gritty details, and I'm passionate about helping them to understand those details first before they jump into it, right? Second is the structure. The structure, people get a lot hung up on that. Hey, I want to, have minimum debt benefit and maximum cash value. But depending on your goal, if you do not have any coverage at all, it might make sense to have a decent amount of death benefit and then add that cash value growth on top of it, right? So it always don't get hung up on, what you want to do, but understand that from the risk management perspective of your financial structure, where do you need to start with implementation, right? The third thing I will say that because it's tied to the life insurance aspect of it, it is really, really important to know that your medical ability or your age is going to play a component in it. Now, while structuring it, while you're it will work beautifully for 25-year-old, it will work beautifully for 55-year-old too, but we just have to have different considerations, right? And a lot of people, I build a model for them and they just say that, oh, this is not a right here, let me just come back to it after 2 years or next year or something like that. And lo and behold, I have seen stroke or heart attack or something happens and they become uninsurable, right? So that's one of the biggest caveat, that insurability is a must, right? Now, does it mean that if you are uninsurable, you cannot implement it? Well, you cannot implement on yourself, but you can actually implement probably on your spouse or your kid, because this structure of banking is what has been utilized, generation after generation. And, families like Rockefeller families and Ford and, corporations like Walmart and PG&E, they have been utilizing in their structure. And how do they structure it? Is that they structure it based on what eligibility that they can qualify for, right? So in your family, you can think about it as a business, and you can think about people who can qualify if you don't qualify to it, right? And lastly, I would say that this is not an ordinary life insurance. This is structured to overfund it and make it over efficient so that it compounds and grows. And remember where that compounding is coming from. It's coming from the dividend insurance companies paying, as if you are a part owner of their system, right? From their book of business, from their profit. So more money that you have in here, the more dividend is going to get paid. So people, when they start implementing it and they create it, and if they don't overfund it, at least for first few years, that velocity of money is not going to get triggered. Einstein says that, compound interest is the eighth wonder of the world. One who understands it earns it, and one who doesn't pays it, right? So we want to be the earning part of it, right? So I think that's the biggest thing that I have seen people, that they create the structure, but they don't utilize it well, and they say that, hey, it's not doing what it's supposed to do.
Gotcha. So you mentioned earlier that you pair these together. So you pair this with syndications. We talked a lot about infinite banking, and we don't have a lot of time, but let's talk about a little bit how you pair these two strategies together to get even more compounding benefit.
Absolutely. So like I said, the and asset, right? Whether it's your investments, whether it's your expenses, this money does not come out. And I'm going to give another example, right? We are all familiar with 401k loans, that you can take loans from your 401k. Now imagine your 401k say has 400k sitting in there, right? If you take a loan from it, 100k, it depletes to 300k. The 100k comes out of it, and now every year you start paying some loan portion, some interest portion back to your 401k account, right? So So yeah, I'm going to give you a comparison of 401k. When 401k, you have say 400k sitting in there and you take 100k loan out of it, your 401k depletes to 300k. Now the next year, starting next year, you put some principal back and interest back, and now you pay yourself. And there's a lot of misconception about infinite banking that you pay it to yourself. It's not true. So once it depletes to 300k, the growth is based on that 300k, not all 400k, right? And now you put that 100k to your real estate or some other use, right? But in case of infinite banking, what happens is if you have 400k sitting in there and you want to invest say 100k into syndicated investment, now you take 100k loan from the insurance company or the third party banks, wherever you want to take it from. Your 400k remains 400k and continues to compound 400k, right? So you take that 100k, now that 100k, think about it, is doing two jobs for you. One is growing that savings and one is that investment into the syndication. Now the best way to look at it is that when you have that simple interest to be paid to the insurance company or any of the bank that gave you that loan, the syndicated investment, if that is cash flowing, now you can take that cash flow and some portion of it can pay that simple interest. Now after that, say that 3 to 5 years, when you have that exit and you have that 2x money and your principal comes back and your equity comes back, now you have almost, say doubled your investment. Now this is the money, with that small cost of that simple interest that you have paid over that 3 to 5 years is in addition to what this 100k has grown in that 4 or 5 years, compounded every year. So that is the beauty of infinite banking, that the money that you take out and utilize it, because you're taking a leverage, it does not physically come out, it continues to compound. And that's how you do an and asset, that the same dollar is doing two jobs at the same time while you are sleeping. And I love syndications for the same purpose too, because it's completely passive. Both infinite banking and syndicated real estate, you don't have to babysit, just like a rental real estate, right? You don't have to, churn between the investments, or you don't have to, expense between the investment, between the tenants as well. So that's the beauty, that, while you are sleeping, both these strategies are kind of creating that super velocity for you at the same time. And at the same time, the third aspect, which again gets ignored, is your death benefit is also compounding while you're sleeping silently, so that when you die, there's going to be significant amount of death benefit that's going to get passed as well.
Is there a way to borrow against your death benefit?
So the cash value is what that you can borrow against, not the death benefit. But again, it's a cash value or the death benefit. It's utilizing the same system. The being your own bank,
Right?
It's the same system, right? So you can borrow against your cash value, not the death benefit.
So there's no way. So let's just say, because I know you can borrow against the cash value, right? But if I'm going to die in 5 years and a creditor knows that my heir is going to have, $2 million, is there any way of them making a loan on that future value?
Well, that as long as it stays inside the cash value, that's kind of an asset protection automatically provided many states. But this is kind of a lawyer question. I'm not a lawyer, but I'm sure if you do some kind of estate planning, or have your beneficiary as an estate, that you can provide those kind of protection even for something's coming out. But again, going back to the death, nobody knows when the death can occur, right?
It's true. Yeah. It would be a risky
but what's
loan,
interesting,
but I've
yep,
always wondered that, like, when people get loans from loan sharks to go gamble, right? Like, people will lend on some crazy things.
yeah, yeah,
So not safe. It just popped into my mind again, but pretty
yeah.
outside the box.
But that brings me to an interesting aspect of it. When you're building a life insurance vehicle and this infinite banking, again, people get so much focused on the cash value and the cash value growth that they forget the other aspects of it. There are some living benefits which are tied within at no cost or at some cost, right? And this benefits at no cost is, something called chronic illness rider. If you, 2 out of the 6 living activities, if you're not unable to do, and which is a permanent situation, you actually start getting, paid for that home care or the nursing home care. It's not your classic long-term care insurance, because long-term care can provide you even if it's a temporary situation, but in this case it has to be like a permanent situation. It also kind of accelerate your death benefit if you have a terminal situation where you have less than 12 months to live, and you can actually access some amount of death benefit, and people typically take that, go on a sabbatical and enjoy that last 12 months of the life. So certain things that change, and these two benefits are available at no cost on most of these insurance provider carriers. And another benefit, something like a disability waiver, if you have a disability in your life, the sustenance of this life insurance premiums, the policy premiums, it goes on the auto sustenance, and there's a small cost to it. So there's certain things that you can do which can provide you an extra added benefit as well. Because in normal, like I said, what is the option that you have when you put your savings into the bank account? Can the bank give you the death benefit? Can the bank give you the living benefit? And there is enormous benefit on having this, because this is a kind of a risk in our life, right? We have to provide kind of a mitigation solution for a different kind of risk to our death if something happens to us medically, right? And this is what it provides, just on the basis of the same savings you otherwise can have in your bank account. But now instead of the bank account, you're just moving it in a more secure, more sustainable system that has never lost money. By the way, I was talking about, Rockefeller's family and, other people, other billionaires, they're using it, the way they utilize it, that the moment the baby is born in their household, they create this system, overfund it. And by the time they're 20, 25, they have money for their business, for their education and whatnot. Even, majority banks, like, they use this for their top executives. And it's called bank-owned life insurance, BOLI. And if you look at their FDIC insured books, there is a line item called how much BOLI that they have. And they have billions and billions of dollars into this BOLI. The corporations like Walmart, P&G, they have on their corporate executives, that's called COLI, corporate owned life insurance. So they are also, building this huge amount of life insurance on their corporate employees, and they have billions and billions just tucked away in this asset class, because this is more secure. Even for the banks, this shows really good on this as a strongest asset on their books. So I often wonder that the same banks like Bank of America and Wells Fargo, when they are doing this BOLIs, why are they not mainstream? Why people like, common people like us, why are we not aware of it? And this is the reason, why I even started Think Outside the Stocks, my company, as a first generation immigrant, is after being exposed to this out of the box and out of the stock strategies, and realizing that people who come to this country and start afresh have absolutely no idea that these strategies have been utilizing over and over, generation after generation, by the top 1% of America.
Yeah, it's pretty amazing. So did you say that this is only available within the US? Like, can you use infinite banking in India or the UK or another country?
So every structure is different. It has to be very, very carefully done. We are talking about a whole life product with mutual companies which are paying dividends, not tied to the stock market specifically, right? So anywhere that they have this kind of structure, there is a possibility to build it, as long as the structure needs to be, modified to overfund it. But, US definitely you can use it. I know Canada, you can use it. India, I haven't looked into it deeper, but, if there is a product which is similar, I'm sure that, there's some way of utilizing it. But again, coming back to the US, right, there is not too many regulations when it comes to life insurance. IRS does not have too much control it. So, Benson, think about it, that once you pay that tax dollars, right, and you put it into infinite banking, your banking structure, it's growing compounded, tax-free. Now it's leverage that you're utilizing while you're alive. It's being utilized tax-free, and you're passing income tax-free death benefit to the next generation, right? It's tax-free once you have put into it. So IRS doesn't really, liked it. And in 1980s, insurance companies used to print this one-page full ad, and well, they used to like overfund these policies without any limit. So there was one rule that was brought by IRS, and it still holds true, is that when you add cash value to it, it has to be in proportion with the death benefit, and it's called MEC limit. So it has a limit for, for 7 years, how much you can overfund this. And when we are structuring it, I'm very careful about understanding that limit and building that limit within and making the clients aware of that limit, right? Because if it goes beyond that, it loses its tax beneficial status. Now some people utilize that to overfund it. It doesn't matter for them, because they're not going to utilize it their lifetime, probably just for the heirs. But that's the only kind of a rule that IRS has on this turf. So in US, compared to other nations, I mean, there could be different kind of rules and structures in place in each country's kind of rule book. But in US, this is the only rule that they have, and that's the only kind of limit that we have to manage. But otherwise, life insurance is kind of a completely different ball game when it comes to IRS rules.
It's amazing. It's so it's so cool that this is out there. And like you said, most people just don't know about it. And even if they do, they don't understand it. There's so much misinformation out there about, even if the policy is structured entirely properly, like you described, people still don't understand it. And people will still say that strategy is not as good as like another strategy, because they have some self-interest in selling a different strategy so they can try to poke holes in another strategy. And you see that from a lot of salespeople on the internet and different social media, where they're just, both sides are kind of attacking each other. But, if you do your research and you look at it objectively, you can see that there are more benefits to this strategy. And then that paired with some sort of a passive investing strategy like syndications, like you said, it just compounds even further, which makes it like this superpower that you cannot get from anywhere else. And, if people are out there and you're just thinking, okay, I'm going to put my money in the bank, you're losing money, like with the taxes and with inflation. If it's just in a normal money market or like a normal bank account, you are losing money. Your money is seriously just sitting there, and it looks the same. It's the same amount of dollar value, right? Because that's not going down, and it may even increase because of the slight change in the interest balance. But really, when you compare that to last year's dollars, it's smaller.
Yeah. And at the end of the year, when you're paying that taxes, it doesn't change your bank account. So it's kind of an illusion that, hey, my bank account didn't change, but effectively you did end up paying that tax from some other, account or some other, withholdings that you had. So it's kind of an illusion that we have about our savings. But like you said, that, there's so many people will come back and say that this strategy is better or this strategy. You have to always remember that infinite banking is about that foundation. And when you are talking about foundation, it's about two things. It's about guaranteed growth, and it's about building that emergency that never ever deplete, right? So the guaranteed growth keeps on increasing it. It should never retrogress. It should never go back down, right? And that's the important. It should never ever evaporate, because it's your hard-earned money. It's your emergency money. If it is 100K, it should never be even like 99,999, right? So it should be always going up from there. And that's the basic of it. It's not your investing strategy. This replaces your savings need, your CDs, your bonds, your treasury yields, because now you have this super powerful, which also protects on your life as a foundational asset. So that's a really important aspect for you to remember. And as you build that foundation, because of your foundation, now you can put walls, now you can put roofs, and you can start taking risk managed approach with syndication. You can start speculation with stock market. You can even go into crypto as a roof, right? But as you go up, I look at it as a pyramid structure. Your foundation needs to be stronger. And because it's strong, now you can take more risk on the top of that pyramid, and you can, invest something, just throw in some money into speculation. But if you don't have this foundation and you just keep on speculating, then where is your base and what is going to protect you? So that one thing I'm going to ask your listeners is that, when you think about paying your money for insurance for car, when you're paying your money for insurance for house, one is a depreciating asset, one is an appreciating asset. After 30 years, if you have just like a term, if you have, 20, 30 years term, are you going to say that, after 20 years, I don't need a car insurance, or after, 20 years or 30 years of paying mortgage in your house, that, hey, my house is completely paid off, now I don't need an insurance, so I can just cancel my insurance. My friend, that's what we are doing to our biggest appreciating asset, which is us. Every year after year, our ability to make more money is increasing. Our expertise are increasing. We are the goose that gives the golden eggs, and we are not insuring us enough. Most of the people that come to me, they have just a term life that's going to expire in 20 years or 30 years, and they don't even look at, whole life as a different perspective. And that's the question that I ask, that if you tell me that you're going to drop your car auto insurance or drop your home insurance after 30 years because your home is now completely paid, that's exactly what you're doing with your whole life insurance. That, hey, I'm going to just drop off the term after 20 years because my liabilities are done. You are at your biggest money-making capability for your family. If you go away, there is a tremendous loss, and only whole life can take care of that.
Amazing. Well, Madhavi, thank you so much again for being here. I really appreciate you sharing your expertise and your background, and you're just a wealth of knowledge. So thank you for being here. It's been a pleasure.
Absolutely, Benson. And, thanks for having me here. And if you're any of the listeners want to learn more about infinite banking or syndication, or how both of them can be done, they can just head to Think Outside the Stocks with S. And there's, a lot of masterclass under resources. And one of the masterclass is the infinite banking masterclass. And they can definitely, just understand this infinite banking, the basics of it. I can also give you a link in the show notes so that you can distribute that.
We'll put that in there. So it's thinkoutsidethestocks.com.
Yes, it's thinkoutsidethestocks.com, and I'll give you a direct link to the masterclass for infinite banking as well. If they want to listen in to my podcast as well, Think Outside the Stocks, or any of the social media handles is the same. I would love to get connected, and if this is a little bit even intriguing for them and they want to learn more, that's my passion, to educate them about infinite banking and how they can utilize as an and asset, whether it's real estate investments or anything else. I love to look at their structure, their goals, and see how this can be implemented. So I'll be happy to talk to them. And what an honor for inviting me. Thank you so much for having me on your podcast.
Oh, you're welcome. It's been a pleasure. Thank you so much. We'll also put the links for Connected Capital in case they're looking for a place to go and be a part of a community of fundraisers and fund managers for syndications. We'll put that in there as well. But thanks again for being here. And everybody, thank you for listening to this edition of the REI Hacker Podcast. Keep an eye out for more amazing guests like Madhavi in the future, where we talk about business and entrepreneurship and real estate investing and wealth creation. So thanks for listening, and we'll see you next time. Take care.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.